There is no point in investing in REIT stocks, and here is a perfect example. Extra Space Storage Incorporated is a real estate investment trust, REIT, that had 140 properties at the time of its IPO in 2004. The company now owns approximately 3,700 properties across the country, demonstrating significant growth. Let's dive deeper into the financials. The company's revenue is growing steadily, as are its net profit, capitalization, and debts. The only downside is issuing additional shares, which dilutes shareholder ownership. Considering all of its accomplishments, I rate the company a 2 out of 10. While it has made incredible strides over the past 20 years, a closer look at the business reveals many weaknesses. One of the major issues is REIT status. While some may find this useful for tax savings, to maintain this status, a company must distribute at least 90% of its net income to shareholders as dividends. Today, the company's stock is valued at approximately $140 per share and has a dividend yield of approximately 4.5%. While this may seem significant to some, it is important to remember that this is 90% of their net profit. In other words, if it were 100%, those dividends would be about 5% per year. Taking into account the 20% tax on such dividends, shareholders receive about 4% of net profit per year. But that's all you get as a shareholder of this company. In other words, it's better to buy something like Kraft Heinz or invest in the S&P 500, where the potential return is higher. Taking a closer look at its earnings, we see that the company acquired more than twice as many assets as it had in 2021. It would be logical to see an increase in revenue proportional to the increase in these indicators. However, we see only a slight increase in these indicators, and net profit even decreased. Although the number of shares has increased, shareholders now own more assets than ever before, which in my opinion is a positive indicator. The company's current market capitalization is around $30 billion, although I believe the company is worth no more than $18 billion. Why do I think this? I want to ask you, why are we investing money? I invest to make a profit, and you probably do too. So, in my opinion, if his assets are worth about $15 billion, I'm willing to pay an additional $3 billion for the brand and network, but no more. Because if I pay $30 billion today and get $15 billion in assets with a 5% annual return, it will take me almost 20 years to break even and earn nothing. Now you understand? This investment doesn't make sense to me. Any other dividend aristocrat would be 10 times better than this company. But if you want a 100% chance of earning less than the stock market, or simply protecting your money from inflation, you can buy shares of this company. Personally, I wouldn't buy the stock even if the share price was $70 per share, which is what I valued it to be. Subscribe to my channel so you don't miss other videos.